a mode of consideration of M&A deal. So M&A deal happens in two modes. One is the cash mode, other one is the shares mode. Now in cash mode, cash is given as the purchase consideration. In shares mode, shares are given as the purchase consideration. Depends on your dealing, guys. Depends on your dealing. There's no recommendation. There's no better way or worse way. Depends on your dealing. Depends on whether adequate cash is available with the bidder company or not. That is also a question, because having huge cash under the kitty is also difficult sometimes. So it depends whether cash is available or not with the target company, with a bidder company. If cash is not available, then what is the option? Option is bidder company will issue its shares to the target company. That is the option. And sometimes there's a combination of both. Partly the consideration can be in cash, partly the consideration can be in shares. There can be a mix and match of both of these also. Okay, so now under these circumstances, when if cash is required to be paid, then it's very easy, simple, plain vanilla case where the purchase consideration, whatever has been calculated, we pay that amount in cash. But what happens in case of shares? That is what we are going to discuss in our next section. Swap ratio, we are going to discuss about what is swap ratio. Swap ratio is actually the exchange ratio. Let's read the definition once. Swap ratio is the ratio at which the acquiring company will offer its own shares in exchange of target company. So it's the ratio in which the shares are going to be exchanged. That is the swap ratio. Okay. Mode of consideration, we have cash and share mode of consideration, and in case of large transaction, stock for stock, which is shares as the consideration is the consideration which is being paid. Stock for stock is paid, and it is actually known as equity as a currency of deal. So the deal is being exchanged in terms of equity. So equity is treated as the currency of deal. That is the popular term which is being used for stock swap, stock to stock exchange. Equity as a currency of deal is being used for the stock exchange, which happens quite often. Okay, and that this is the swap ratio. Swap ratio is the exchange ratio in which the shares are exchanged of bidder company and target company. This swap ratio is computed in various ways, and now in the subsequent sessions we are going to discuss about this swap ratio. Okay, what is swap ratio? That is what we are going to discuss now, and specifically in case of exchange of shares, we are going to compute this swap ratio. Okay, sir, got it? Yes, guys. So, okay. So let us consider a simple example. So this is the example in front of you. Okay, let's consider this example, guys. What is the example? Example is there are two companies, Bidder Limited and Target Limited. Okay, both of them are wanting to enter into a stock swap. Swap is required to be done. So target company is being sold, bidder company is purchasing the target company, and in return of assets and liabilities of target company, bidder company is giving its own shares to target company. Now the question is, how many number of shares should bidder company give to the target company? How many number of shares should bidder company give to the target company? Number of share of bidder company are 1 lakh shares. Number of shares of target company is 50,000 shares. Market price per share of bidder company is 50 per share. Market price of target company is 25 per share. NAV of bidder company is 15 per share. NAV of target company is 12 per share. EPS, earning per share of bidder company is 2.5. Earning per share of target company is 4. These are certain basic numbers and figures which are given to you for your analysis purpose. Now the question is, how many shares of target company? So target company existing shareholders are 50,000. These are the existing shareholders. Now they are going to revoke their ownership. They are going to revoke their interest in the company, and they will give it away to the bidder company. In exchange, they will get shares of bidder company. Now the question is, in exchange of these 50,000 shares, how many shares should shareholders of target company get in bidder company? Simple, sir. If you see it from the angle of the target company shareholders will always want more and more and more and more number of shares of bidder company. So target company shareholders will say that, okay, in exchange of 50,000 shares, we should at least get 5 lakh shares of bidder company. They would say this. They would want more and more and more shares of bidder company. They would want to have any number of shares of bidder company. In case of bidder company, they would always want to get they would always want to give lesser amount of number of shares to the target company. They will ask the target company to take lesser share. They will try to convince the shareholders that take lesser number of shares, don't take excess shares. They will try to convince the target company shareholders. So there's always a conflict between the target company and the bidder company. Bidder company will always want the target company to take lesser number of shares. So they will try to convince target company that, look, target company, you take only 5,000 shares in return of your 50,000 shares. You take only 5,000 shares in my company. Because guys, more number of shares you dilute in bidder company, your existing shareholders will have a lesser share in the new company. Okay, so we want to dilute less in our bidder company. In the merger and acquisition deal, we want to dilute less. That is the idea behind issuing less number of shares to target company. And target company would always want higher number of shares in the bidder company. They would always want more number of shares in the bidder company. So if they are having 50,000 shares, then they would want 5 lakh shares to be given to the target company. And guys, don't think that out of these shares will be issued. There will be new shares will be issued. Fresh shares will be issued. These shares will be untouched. These are the existing shareholders. These will be untouched. Fresh shares will be issued of bidder company and they will be supplied to the target company shareholders. That is the way in which the stock swap happens or the share exchange happens. That is the way in which this happens. Okay, now how to end this conflict between bidder company and target company? The way to end this conflict is look at the vital statistics of both the companies. And by vital statistics, I mean look at the market price per share, look at the earnings per share, look at the NAV per share of both the companies, and then decide how many number of shares should be given to Target Limited. Then decide, guys. Like let us start with an example. Market price per share of bidder company is rupees 50. Market price per share of bidder company is rupees 50. Market price per share of target company is rupees 25. Half of the bidder company. So bidder company's shares are worth double than that of target company's shares. These are worth double. So if I were to ask you, how many shares should target company get in exchange of its 50,000 in the bidder company? You will easily tell me, sir, 25,000. Sir, 25,000. Because the shares are priced at a half price. These are very cheap shares. So if you're getting the similar shares in bidder company, then only half of the shares should be given. So out of 50,000, only 25,000 should be for exchange of 50,000 shares. 25,000 should be issued in the bidder company. You will always say that. Of course, yes. Of course, yes. Half number of shares should be issued to the target company shareholder because its value is half. That goes by a logic. And how do we compute? Please see the computation, guys. So total target company shares are 50,000. Total target company shares are 50,000. Their worth in market is multiplied by 25. And what are they being exchanged for? They are being exchanged for a share worth 50 rupees. So how many new shares should be issued in this case? New shares which should be issued is 50,000 divided by 50 multiplied by 25, which is 25,000. Which is 25,000. So 25,000 shares should be issued to Target Limited shareholders in bidder limited. That is how we compute it. Okay, sir. Now coming on to the NAV, net asset value. Now again, guys, same formula I'm going to use. 50,000 multiplied by the NAV of rupees 12 divided by the NAV of the bidder company. So 50,000 multiplied by 12 divided by 15 gives me a figure of 40,000 shares. Gives me a figure of 40,000 shares. So 40,000 shares are being issued to the target company shareholders in the bidder company. That is the amount that is to be written. Last, so guys, in first two cases, bidder company was very much happy because its price was more than the target company's price. In first two cases, bidder company was very happy. It was actually dancing like this. It was dancing and saying, wow, I am getting a higher valuation because my parameters are higher than target company. So I will give less number of shares. So my equity share ownership will be diluted in a less manner. Wow, wonderful. So we will do dealing on the basis of these higher numbers. So 15, 12, again a higher number. I will have to issue less number of shares to target company shareholders. So the bidder company was very happy. soon as the game transferred to the last value, the last parameter was earning per share. Now target company shareholders were actually dancing and making merry. Wow, amazing. Target company shareholders were saying that, look, EPS of our company is 4, EPS of your company is only 2.5. We deserve a better deal. So what will happen in case 4? 50,000 multiplied by 4 divided by 2.5. This will give me a figure of 50,000 divided by 2.5 multiplied by 4 gives me a figure of 80,000 rupees. Gives me a figure of 80,000 rupees. So yes, the target company is very happy. In the last case, if the option is given to target company to choose one of the 3 ratios, it will always choose the last ratio because it is giving maximum benefit to target company. In exchange of its 50,000 shares, it's getting 80,000 worth of 80,000 shares in bidder company. So target company is very, very happy in the last case. If you talk about bidder company, then bidder company would choose the first case because in this case, it is paying lesser number of shares to the target company. If you talk about the bidder company, it will be happy in the first case. It will take the parameter of the first case. If you talk about target company, it will take the last case. Now, sir, finally, what will be decided? Guys, somewhere between these two will be decided. Somewhere between these two will be decided. These are two extremes. Now, negotiation will happen on the table face to face. Bidder and target will sit on the table face to face, and they will decide which parameter should be chosen, which parameter should be selected. On the basis of that parameter, the final deal is to be struck or the final deal is to be closed. That is how the valuation, the swap ratio is computed. Now, what is swap ratio? Swap ratio is this figure, guys. This. So, when you talk about the swap ratio, it is this. This is the swap ratio. 4 divided by 2.5. This is the swap ratio. Ratio in which the shares will be exchanged. 12 divided by 15. This is the swap ratio. 25 divided by 50. This is the exchange ratio or the swap ratio. So the formula of swap ratio is EPS of the target company divided by EPS of the bidder company. And soon as you multiply the swap ratio with the existing number of shares of Target Limited, you will get the new number of shares of Target Limited. So if I were to write the formula, new shares of Bidder Limited to be issued to Target Limited, the formula will be existing shares of Target Limited multiplied by the swap ratio. Existing shares of Target Limited multiplied by the swap ratio. This is the formula which we are going to use to compute the new number of shares of Bidder Limited which is issued to Target Limited. Formula is existing shares of Target Limited multiplied by the swap ratio. What is the swap ratio? Swap ratio is the parameter of the target company divided by the parameter of the bidder company. So numerator will always have parameter of target. Denominator will always have the parameter of the bidder company. This is what you need to learn. Okay, you need to actually remember this thing, that numerator will always be target company because we are multiplying the existing number of shares with the numerator first, and denominator should always be the parameter of the bidder company. That is what we need to remember. Okay, sir. Got it? So this was the concept of swap ratio. Let's read, guys. Swap ratio, a ratio at which the acquiring company will offer its own shares in exchange of the target company's shares during a merger or acquisition deal. For example, 10 shares of target company are exchanged for 1 share of acquiring company. So 10 shares of target company is being exchanged for 1 share of acquiring company. In this case, the swap ratio is 1:10. 1:10 is the swap ratio. 10 shares of target company being exchanged for 1 share of acquiring company. Okay. Basis of computation of swap ratio, one or a mix of following basis can be used. Earning per share can be used. Market price per share can be used. Book value per share can be used. NAV can be used. Any of these can be used as a parameter of computing the swap ratio. Following formula may be used, and this formula you need not mug up because I've made you understand this formula. EPS or MPS or BVPS or NAV of the target company or the acquired company or the selling company whole divided by EPS, MPS, BVPS, NAV of the bidder company or the acquiring company. So you need to just divide these formulas to get your answer. Okay, sir, got it.